Tesla shares dropped in today's stock market report. Tesla's stock was valued at $256.60 per share at the market closing on June 23, 2023, a loss of $8.01 or 3.03% from the previous day. After-hours trading saw the stock drop to $253.18, down $3.42 or 1.33%. In a recent interview with CNBC's Squawk Box, Barron Capital CEO Ron Barron addresses the U.S. economy, market forecast, and investing in Tesla. Tune into this lively discussion to gain useful ideas and remain informed.
All right, so what do you want to talk first? You want to talk the broader markets picture? Or do you want to talk Tesla and the run-up of it? Let's see.
Well, so I just want to mention for a second about, I'll talk about that in just a minute. I know that's where you want to get to. But yesterday or the day before, I was watching your show, and you talked about ESG and how a lot of states are passing legislation or trying to pass legislation to say you shouldn't consider those factors. You should only consider how you can make the most money. And I would point out that we do consider those factors. We do consider good governance, how you treat employees. If you're not treating your employees well, how are you going to retain them? How are you going to hire the best? And how are you going to keep them? How are you going to train them? So basically, we're interested in these things, and also we're interested in making sure that the companies in which we're investing haven't got these risks that we're not aware of. So we are conscious of that. And to argue against the idea that it's not important about how much money you're able to, only making most money is what's important, that we've been conscious of this. And because of that, we've outperformed. So 98.8% of our stocks of our funds have done better than the market, and 45.5% are in the top 1%. Not only in the top 1%, but number one in their categories. And Barron Partners Fund happens to be the number one performing mutual fund in the United States since 2003 when it became a mutual fund. So we have been able to perform well, taking into account these elements.
Let me just say, though, ESG, I think it depends on who's using it and how they're measuring it. Obviously, you're not going to say you're against the environment. You're not against social or governance issues. But sometimes people get in and measure things in crazy ways. And I think a lot of the pushback comes from the bureaucracy that comes from this and the greenwashing that this is used to dress up or dress down other places. And I think part of the problem comes from, big institutional shareholders who have said you're going to do things this way. And it's not their money that they're even talking about.
I agree. Well, we're not like that.
Yeah, I think this argument gets so convoluted because it really depends on what you're talking about when you say ESG.
I agree. I agree. Anyway, so we are conscious of how companies act and how they treat people and how they treat shareholders, and so we're aware of all these things. Our business, we keep expanding. We've never had a layoff in the history of our business, so therefore people feel comfortable working for us. They trust us. And we just keep growing. So we're now 197 people, 45 are analysts, portfolio managers, and we do the best we can for our clients, and we do the best we can for our customers and our employees and shareholders. And so one of the things I think is really important is that we don't worry about the stock market. We don't worry about interest rates, economy, what the government's going to do, wars. In my whole history, there's never been a good news year, with one exception, when they took down the wall in between East and West Germany. That's it, one good year from my whole career. And yet, the stock market in this whole period of time, with terror attacks and inflation and wars and pandemics, with all of that going on, the stock market is up 34 times since 1970 when I began my career. It was 1,000 then, it's now 34,000. And the economy, by the way, in that whole period of time, is also up. It's up 33 times. It's gone from $800 billion of GDP to $26.25 billion. So despite all this stuff everyone talks about all day long and trying to figure out what's going to happen, the market's up 33 times. And what I think is growth is now beginning to accelerate. And over the next 50 years, compared to the last 50 years, I think that you're going to have faster growth than 7%. But assuming that you get the same 7%, that means that you're going to have 35 times your money over the next 50 years, which means that the Dow Jones, which is now 34,000, will be 900,000. So when everyone talks about well, is it going to be 32,000 or 33,000 or 30? I'm thinking about 900,000.
Why do you think faster growth over the next 50 years? Because there's a lot of people who think, let's say over the next 10 years, you could see much slower growth than 7%. I mean, that's been the concern for a long time.
Well, inflation is 4 or 5% of that 7% growth, and real growth has been 2%. And all the growth that's really happened in the world has taken place in the past 20, 30, 40 years. And that's accelerating because of technology.
Inflation, but you expect inflation to be higher too?
I expect inflation to be, as it always has been, as it has been in every single democracy that's ever existed, 4 or 5% a year. So I think everything is going to be twice as expensive in 14 or 15 years as it is today. So it might touch down at 2 or 3%. But even Volcker, when he left in 1986 or 87, even then it was down to 3% from 18 or 19. We've gone from 9 or 9.5 to 4 or 4.5 or something like that. So maybe go a little bit lower, but it's not going to stay lower. It's part of our economic program.